Hey guys, welcome back to RWM Finance, and today's topic is what is intrinsic value? And in this video I will discuss intrinsic value along with some other topics that I discussed in my video how to invest like Warren Buffett, like dollar cost averaging, compound interest, and one more, so make sure to stick around to hear about all of them. So if you haven't subscribed, please scroll down and click that subscribe button for me, and then we will just move right on into the topic. So there were some terms and topics that I felt that I should go into a little bit more depth on. That way y'all would be able to better understand them, which would hopefully allow y'all to use them to your advantage. The information that I'm going over all came from the book Buffettology, which I mentioned in the video How to Invest Like Warren Buffett. The link for the Buffettology book by Mary Buffett and David Clark is in the description bar below, so y'all make sure to check it out. So the first term that I felt that I should expand on is intrinsic value. In the video over how Warren Buffett invests, I said that Warren focuses on the intrinsic value of companies, and that is one way that he decides which company to invest in. So what is intrinsic value? Well, intrinsic value is the measure of what an asset is truly worth, separate from its market value or share price. The stock market is really just a bunch of opinions. When people like a certain stock or a certain company, they buy it, and then the stock price generally rises. But the share price is not the true value of a business or an organization's stock. So this is where intrinsic value comes into play. It cuts through all of the opinions and Wall Street crap and gets a business or organization's value down to one number, one true value. According to the Buffettology book, intrinsic value of an investment is the projected annual compounding rate of return the investment will produce. Now, the rate of return that you actually get is largely impacted by the price that you pay for the shares. This is why Warren suggests that you find what you want to invest in and then wait for the price that you're willing to pay. Now see, what I've always heard is that time in the market beats timing the market, which is really what Warren is trying to suggest that we do. In fact, very few managed funds that try and time the market actually beat the market. But Mr. Buffett is one of the few that actually beats the market majority of the time. So I'm not trying to tell y'all what to do, but I'm just trying to present y'all as much information as I can. That way y'all can come to a decision based off the information that I give you and what you already know. So if you would like to wait and try and time the market, a recession usually occurs every 1 to 3 years. According to the book Unshakable by Tony Robbins, and the link to that book that I've read is down in the description bar as well. Now, the next term that I would like to discuss is dollar cost averaging. I actually mentioned this term in one of my previous videos, but I never really got around to kind of explaining to y'all what it is. A saying that I got from the Buffettology book really kind of helped me understand a little bit more what dollar cost averaging is. So the saying is, short-term volatility is what creates opportunities for long-term investors. And an example that I have actually already used in a prior video, which I feel is the best way for me to try and explain to y'all what dollar cost averaging is the gas prices analogy or comparison that I came up with. So say you put $40 worth of gas in your vehicle each week. As you know, gas prices can rise and fall just like stocks do. But if you continue to put $40 in consistently on the weeks where gas prices fall, your $40 will go further and allow you to get more gas. This is the same with investments. If you are consistent with your investment, no matter what the prices are for 10 to 30 years, you will allow short-term volatility of those investments and dollar cost averaging to help make you some serious money with your investments. Now, moving on to the next term that I would like to go into a little bit more depth on, which is compound interest. In my video over how Warren Buffett invests, I mentioned that Warren credits compounding interest as the secret to getting rich. So, what is compound interest? Well, it's the addition of interest on an initial principal investment along with the accumulated interest from previous periods. Basically, compound interest can be simplified to the definition of interest on interest. Compound interest allows an investment to grow at a much faster rate than simple interest. Now, I gave y'all an example of how effective compound interest is at growing your investments in the video over how Warren Buffett invests. If you were to put $300 every month for 8 years into an account, into an investment portfolio, the total for that investment portfolio would be $28,800. Now, say the market goes up 10%. Never mind. We'll go 8% over 30 years. That $28,800 would add up over that 30-year period to be $1.8 million. I know, that's pretty crazy, but that is the power of compound interest. Along with dollar cost averaging, compound interest is another reason to invest for the long term, which is probably why Warren's favorite holding period for his investments is forever. Finally, the last term that I would like to expand on is diversification. In the How Warren Buffett Invests video, I mentioned that one of Warren Buffett's investment strategies is to learn one area really well and don't stray too far from it. So when you look at this from an investment portfolio standpoint, it means to have a pretty concentrated portfolio or don't diversify too much. Diversification is really just a risk management strategy, and you do this by mixing in investments from different industries within one single portfolio. Like I said, it's a risk management strategy because you don't want to get caught investing too heavily in one single industry, and then that industry be hit by a crash like the real estate market did back in 2008. Now, what I believe Warren means by having a concentrated portfolio and not diversifying too much is because whenever you diversify too much, it's the same as the reverse. Diversification is a good thing. It's a good investment strategy, but too much of a good thing could be bad as well. So basically, just don't spread your investments out too thin because that can be just as bad as the reverse, like I said. But if you don't want to diversify with just individual stocks from different businesses or organizations, Buffett also advises people to invest in low-cost index funds, like the S&P 500 or the Dow Jones. I have also read that low-cost index funds are good investments within the books Unshakable and Money Master the Game, both written by Tony Robbins, and the links to both of those books are in the description bar down below. Well guys, I hope this video helped y'all understand those terms a little bit better and how they can actually help y'all out in your investment ventures. Also, if you enjoyed this video, scroll down, give it a like, and subscribe to the channel below. And if you have any questions or concerns or comments, leave those in the comment section. I will try and get back to every single one of y'all. Remember guys, I post videos every Monday, Wednesday, and Friday, so y'all make sure to tune in for the next video. Thank y'all for watching, and I will see y'all in the next video.